So, hello and welcome everyone to today's weekly market outlook here together with Admiral Markets. My name is Jens Klatt and I welcome you on a, in fact, very special day. So, I have to say I hadn't expected what we've just seen here over the last hours during the European trading session. Donald Trump tweeted once again potential of, or not potential, but imposing tariffs on Mexico, which hit the automobile sector in Asia quite hard and pushed Asian shares, Asian equity markets strongly lower. European equity markets following suit, and we know broke below a crucial support region. And the question is, will the US equity markets follow today, or will there be some kind of reversal or not? So we are in fact in a very, very interesting market environment. Risk off is surely something we have to mention here. It's not only equities being lower, but gold being sharply higher. Same is true for the JPY. And this is surely something we want to have a look at today, and then also answer the question for the upcoming week of trading. What can we expect then next week based on the current bias? But before we start, as usual, we have to have a look here at the risk disclaimer. Trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service. Especially in regards to risk, there is now the ESMA decision. We made a topic several times already in the past, and we want to continue with that also today. So there's now a differentiation between retail clients and professional clients. The main differentiation here is surely that retail clients now have a max leverage of 1 to 30 on Forex majors like Euro USD, for example, or dollar JPY, but also 1 to 20 then on the minors, which is, for example, GBP CAD or GBP Australian dollar, for example, Australian dollar JPY. And surely also worth mentioning here, this 1 to 20 leverage cap is in place for CFDs and indices, especially in gold indices like the German index, the DAX 30. But there's also something else which is worth noting. The thing that this differentiation between retail clients and professional clients is especially true in regards to the leverage restrictions. They are in place for retail clients, but they are not in place for professional clients. So there's certain criteria which have to be met to reclassify at your broker on your own request, by the way, to be reclassified as a professional client. One thing which is very important to note here is that retail clients do not only face a leverage cap in their trading, but after ESMA, but they are also protected unlimited against negative balances, which is not necessarily true for professional clients. But in case of Admiral Markets, they have an offering which says you are protected up to £50,000 sterling according to their policy. For further information on this, please feel free to reach out to Admiral directly. Ask all your questions, see if you are if you can reclassify as a professional client. If this is something for you, sure, you have to make sure that everything around this topic is in place and you feel comfortable to do so if you plan to do that. This is the face to the voice you're currently listening to. So this is me. We want to nevertheless skip this and answer only one question: where I'm located. I'm located in Berlin, Germany, and Admiral Markets has also an office here. We want to have a look at the several offices around the globe here. One office is in Berlin, so fact is that among German traders, especially Admiral Markets, is usually all the time and every time mentioned when we talk about the DAX, and one of the most competitive offerings in regards to DAX, to the DAX 30. Typical spread is 0.8 during the main trading hours. In fact, when choosing the so-called Admiral Prime offering, you can have a spread as low as 0.2 on the DAX 30 and then pay a small commission on top of that. This is in fact based on also the execution speed, quality of the execution around professional traders here in the CFD industry. Admiral Markets usually ranks among the best brokers, and that's yeah, that's definitely something noteworthy. On top of that, there's also a very competitive FX offering. Feel just free to reach out to the website and make yourself familiar here with the offering from Admiral. It's definitely worth give it a try and give it a look first, and then give it a try with a demo probably, and take it from there. Here are the offices around the globe, which you can find. It's not only Germany, but also, for example, Admiral Markets is located in and also regulated and authorized by the FCA in the UK, for example, but also, for example, in Australia, Admiral Markets Pty Limited here, holding an Australian financial services license. In Chile, so around the globe, you can definitely find the offering for you with the customer support in your respective native language. It shouldn't be such a big problem with Admiral. And there are the contact details. Feel free to reach out to Admiral directly. And now we want to have a look at the agenda today. First, a rough one, and then go into further details in the upcoming minutes. So the questions we want to answer today are: what are the key economic events in the coming trading week? In fact, the economic docket is packed next week, so it's in fact a fantastic week, to be honest, especially after now the comments from Donald Trump today. Sure, from this perspective, we have to be a little careful. It's not necessarily positive for the global economy, but from a volatility perspective, we can definitely expect bigger moves to come. Also from the economic docket here, we have the ISM manufacturing on Monday, we have the ISM non-manufacturing on Wednesday, we have the ADP data set on Wednesday, we have the non-farm payrolls on Friday, and that was only the US. Then we have the ECB rate decision next Thursday. So there's plenty of potential market volatility events here, which are in the upcoming week, which you are heading to. And sure, we want to then also answer the question, what's the current bias in the FX equity and commodity markets? Sure, you have already heard at the beginning of this webinar, I referred to a risk off mode, which is clearly playing out right now, depending a little on what the US markets deliver today. But all in all, it looks as if for example, in equity markets, the short side seems to be favored. Also, not only from a sentiment perspective, but surely also from a technical perspective. Also something we want to look at here when we talk about the SP 500, for example. And then we have the trading opportunities, which we want to see, which could arise then in the upcoming week. And yeah, so let's have a look then into the chart. I've prepared here the DAX already. You can see the sharp drop below 11,800 points. I've mentioned this region several times already in the past, and now we've seen the final break below that level. We've also already, in fact, pushed below a quite crucial support level, short term at least, on Wednesday. That was before this bank holiday in Germany. In fact, yesterday the DAX was tradable. Still, the market environment was very thin, and that could be seen also in this drift higher with no big dynamic moves. In fact, we have seen here, and then we found a short trigger because the tweet from Trump happened shortly before Asian markets opened. Also, once again, a perfect sign of what we're after it right now. So it's not only Asia and the Chinese Trump is attacking here, but we've seen this plenty of times in the past too. Seems to be part of the strategy of the Trump administration to also demotivate, or probably demotivate, or to push equity markets around the globe lower, and then start to somehow push equities in the US higher, if by tweets, purely rhetoric, in a pure rhetoric way, or also via another manipulation with the potential plunge protection. I want to show you that this is not just a story we make up here, and we think that this could be the case, but there are several indicators pointing to a manipulation of the US equity markets. That has been seen yesterday and also the day before, so Thursday, and also already on Wednesday at the same time. In fact, we will have a look here at the so-called NYSE tick index. But the thing is, and this is why do I mention this? Well, it means that we are already quite extended on the downside, and if now such a tweet happens, or whatever, some kind of let's try to push or stabilize at least US equity markets, then we have a chance for a sharper pullback into the afternoon and into the weekly close, which could bring us back to these highs, lows here, around 11,800 points, but still the overall picture does not look very promising. So in fact, when looking at the DAX, we are about to at least retest here the this blue line. What is this? This is the so-called simple moving average, 200 in fact, on the DAX, and we can say everything above that is clearly positive and bullish, but, and this is the thing, we are now, after this drop below 11,800 points, we are now entering a mode where we can start to talk about a sequence, beginning sequence of falling highs and falling lows. So from this perspective, it definitely looks not very promising. And in fact, I could imagine, especially if US equity markets can stabilize, I could really imagine the DAX to continue to push lower on the downside. And this is especially probably true when looking at the upcoming week and here on the ECB rate decision next Thursday. So all in all, I do not expect big moves to come, but it's more like a wait and see approach probably. But I mean, it's definitely true that there's not only signs of a potential recession in the US forming when looking at the latest developments, especially in US yields here, very important to note. So US yields, in fact, 10-year US yields pushed to the lowest levels since 2017, and we are now seeing an inversion of the yield curve for several combinations, let's say, which is a clear sign of a recession, of potential recession forming, especially now with the trade war between the US and China, but also between US and Mexico, between the US and Europe, for example, start to gain momentum again. And we have also to see, and this is, I think it's definitely necessary to have a look, first of all, at the tweet from Trump. So that was the tweet from tonight. It's 1:30 at 2, by the way, at 1:30 German time. So at 2 a.m. German time, in this case, Asian markets start to trade. So I don't think that this is a coincidence what happened here. That's something I just want to say. I really think that it's plan of the Trump administration, of Trump himself, to somehow punish equity markets around the globe and try to push them lower, and then act as kind of how can we say that? As a hero for US equity markets, somehow stabilizing it, pushing it higher. So the tweet says, on June 10th, the United States will impose a 5% tariff on all goods coming into our country from Mexico until such time as illegal migrants coming through Mexico and into our country stop. The tariff will gradually increase until the illegal immigration problem is remedied. Yeah, we remember the shutdown of the U.S. government that was during December, January, which made the wall, which was planned to be built here, a topic, and where this wall between the U.S. and Mexico, USA and Mexico, was a topic, the main driver for this U.S. shutdown. And yeah, now Trump is obviously using tariffs against any country to get what he wants. The only problem is he was in China. Some of you remember that no, I'm sorry, not China, in Japan. That was several days ago. And surely Donald Trump loves the Japan people, or the Asian people in general. In the morning, the following tweet was published. That was another guy I'm following. So much for Trump's love to Japan and South Korea. By hitting Mexico, he accidentally hit Asian automakers who happen to have their factories in Mexico. So you can see here Kia Motors, Hyundai, Subaru, Honda, Nissan, Toyota, Mazda, Mitsubishi, all deeply red for the day, and being one main driver for Asian equity markets being lower. And there you can see that those tariffs affect somehow the whole world, because we're living in a globalized world. And this is something which is definitely worth remembering when looking at the current environment, and looking for the main driver for the equity markets, and where this mode is coming from. And so this definitely has the potential to result in an overall recession around the globe, with somehow spillover effects from one country to the another, respectively, hitting the trades, the trading. What's the word for this? Relationship, the trading relationship between two countries here, and this is definitely something which is worth remembering when looking at those tweets from Trump. The thing is that when looking at this current developments here, we have to remember that this is a perfect example of what to expect then to somehow make or have tried to somehow stabilize the markets. And why? Because if you impose tariffs on Mexico here and it spills over and it results in a risk of mode around the globe and pushing US equities lower, but also is pushing, for example, US yields lower, you have to somehow intervene rather sooner than later. And this intervention here can, for example, be seen then in the NYSE tick index here. So yesterday there was something very interesting happening. By the way, we have probably first to introduce this NYSE tick index. It's a very simple indicator, still a very strong one, when it has, or from an intraday day trading perspective, in fact, when, for example, trading physical shares, which is possible with Admiral Markets, the NYSE tick index can be a very, very strong indicator here to see intraday levels of extreme or extremes, pointing to extreme fear, respectively extreme greed. So the NYSE tick index, I have here the article at Investopedia, is defined as such. The tick index compares the number of stocks that are rising to the number of stocks that are falling on the New York Stock Exchange in this case, so NYSE. Yeah. The index measures stocks making an uptick and subtracts stocks making a downtick. For example, if we are looking at roughly 2,800 stocks which are listed on the NYSE, the article was published in March 2018, which means it's still around that number. That means nothing more than if 1,800 stocks have made an uptick and 1,000 made a downtick, the tick index would equal plus 800. So 1,800 minus 1,000. So yesterday we could have seen that here the number was above 1,000, which means nothing more than here, obviously, somewhere in the region, we were somewhere in the region of 2,000 equity shares making an uptick, while 800 made around a downtick. That's rule of thumb here in this context. You can spot it here. So what does this mean? This happened twice at 3:33 Eastern time. So that was around 30 minutes before the Wall Street closed. What does this point to? It shows that there is a strong buying power coming into the market at this time and pushing equities higher, which is a perfect example of potentially the crunch protection coming into play here, trying to stabilize the market, respectively pushing it higher. In the case of yesterday, for example, for the Dow Jones, helping it to close above 25,000 points. As long as we have such forces in the market, and we have a White House, respectively US president, who is measuring his performance as US president in points of the Dow Jones, we have every day the potential for such an intervention and the markets being pushed higher. So that is definitely something worth remembering, which means nothing more for us as traders, especially if we're short-term engaged. We have to be really careful. If there's an extension, especially on the downside, if there's some kind of acceleration, in this case, in the S&P, for example, then it wouldn't come as a surprise to see the market being stabilized, especially into the weekly close. Where it's daily close. Today it's also the weekly close. Let me just open here the S&P 500. If we are, and so far that looks very, very dangerous for the bulls, what just happened. So we pushed below this line. And by the way, let me just probably go to the website from Admiral Markets. We created an article which was initially an article in the traders block section. So admiralmarkets.com, you go to analytics and here the traders block, and this is the latest article. And here we made the double top topic, and then how to trade it, and what's the double top, and where can we find it right now, and what to look for when you spot such a pattern. And in fact, the S&P and the formation here was a topic. This is the theory behind the top, or respectively the pattern. Top 1, then you have top 2. And you see that there's rather sooner or later such a neckline forming. This is a region where you say, okay, this is of interest for market participants because we see a reaction here. We see markets after a bounce back here from top 1 here again. And then the market, there's demand coming into the market. And the neckline gains in terms of importance if this level is tested several times. And then we just call it, as for a head shoulder formation, for example, a neckline. And then what we do is we look at the top, and we have here a difference between the top and the neckline, and we just duplicate this and have a first projected target on the downside. And we did this here for the S&P, and you can see it here. So this level alone is not necessarily important, but you can see before there were several times that the region around 2,800 points here was respected from the market. So after we broke here, after this heavy, it was in fact a crash on the 10th of October 2018 last year, we seen here several retests of this region and the market not making it back above that level. In fact, then accelerating from the beginning of December strongly on the downside. And there was also a reaction here that was then in February, March, and then here also in was the end of March, in fact. And we've seen plenty of occasions where this level was tested. So we can definitely say the region around this, in this case, pink line here, is of significance for market participants. And then what we just do is we look at this neckline. We have a difference here between the neckline and the tops, and then we duplicate this and we get out somewhere between 2,650 to 2,700 points. And this level becomes especially interesting once we push as low as 2,730. And once we get to see this pressure coming up and markets turn deep red in this case, so we are already quite red for the day. As you can see here, we started out at 2,790 around, and currently are trading 30 points or more than 1% lower. If this acceleration occurs then over the day, especially into the last hour of trading, you should become really careful and probably become really aggressive with your stop, because as the NYSE tick shows, obviously there's a strong force then entering the market trying to stabilize equities and potentially trying to push it higher here. So this is definitely something worth remembering when trading the intraday picture here. Still, I doubt that such interventions and manipulations as they happen are of are sustainable, let's say. So I think no one is bigger than the market, and rather sooner than later we have a big chance to see a real collapse. And this is especially true when looking at the upcoming week of trading, not necessarily from an economic perspective. So by the way, I've also prepared, let me just close this here, I've also prepared the Forex calendar for the upcoming week, and you can see plenty of very important news events happening. You can find this yourself, by the way, admiralmarkets.com. You go to analytics, Forex calendar, and there you can choose the time span you want to cover. So in our case, it's the 31st of May. It's today till next week, Friday. And then you can here filter which countries you want to look at and check this box here with 3 red ampoules in this case, making sure that you see the high impact events. And there you can see it, as I already mentioned, ISM manufacturing. Already China is publishing the Caixin, I hope I just pronounced it right, Caixin manufacturing PMI here Wednesday. Thursday, the ECB rate decision plus press conference, non-farm payrolls, so plenty of economic events in the upcoming week. But there's also something else which should be mentioned here, and this covers China. and their potential reaction to the threats and punishments which the US brought on their way already last week. Was it last week or the week before? Not sure. Regarding Huawei and banning Huawei. I think it's 2 weeks ago, and banning Huawei nearly from the US and having access to very important companies and their software solutions like Google for Android, for example. And so far, China hasn't reacted yet. But in fact, they reacted in a very a positive way, let's say. So for example, the Huawei CEO was very positive in regards to Apple, for example. And then also Google emphasized that it was not only from China himself, but also Google. They said, we follow what we just got or what we were being told from the US government. But still, we wouldn't necessarily do that if it wasn't the case. So they all emphasize there's competition between China and the US, but still it's not the case that they are fighting each other, and are happy to see now these measures being taken. And I think they all know that it hurts both sides. And so far, the Chinese haven't yet implemented any countermeasures, but still this is on the agenda. And here is one journalist who is very active on Twitter and being said to be strongly and tightly connected to the Chinese government, in fact. And this is a tweet from today in the morning. Based on what I know, he says, or he writes, China will take major retaliative measures against the US, placing Huawei and other Chinese companies on entity list. This move indicates Beijing will not wait passively and more countermeasures will follow. So far, nothing happened yet, but this is also something which should be remembered. And we should remember in this context that, for example, Apple has still 10% of a weight of 10% based on market capitalization in the Nasdaq, which means nothing more than we have a good chance that here also further losses are very likely to happen. And in fact, what I already prepared here, next week on, I think on Wednesday, it will be published then. Definitely makes sense, in fact. Next week, we'll enter a very bearish seasonal pattern in the Nasdaq. You can see it here. It's from the 5th of June, so next week, Tuesday, we start with this bearish seasonal pattern, and then we see this developing over the next 3 weeks till the 27th of June. In fact, over the last, I think, 19 years, if I'm not mistaken, the Nasdaq has lost 15 years out of those 19, and the Nasdaq and on average more than 90 points. And this is definitely something worth remembering. So also from a seasonal perspective, the Nasdaq enters a very, very bearish seasonal pattern. And also from this perspective, losses seem to be very likely. So if we sum all this up, we definitely can come to the conclusion that so far the overall advantage clearly switched to the bear side, or respectively to the short side, and especially with the DAX trading below 11,800 points, it seems to be very, very likely that we are about to see further losses, especially if we drop below the SMA 200 here. Still, nevertheless, even if this is the first conclusion we can draw here based on everything I presented, still we should be really careful, and in fact, I'm really excited to see how the US react today, and if there will be any kind of action being taken to stabilize US equity markets and save it from a further drop. If this fails, if such an attempt to stabilize the market fails, we should clearly see, or I definitely see further losses being very likely, and could be a deep red close, and probably also a weekly close below the 200 SMA here on a daily time frame, weekly close on the daily time frame then, which would be definitely a bearish sign for the days to come and would definitely favor further losses then. So that's it on the DAX. Let's now switch over to the currency markets. In this context, let me probably just extend this line here a little. In fact, the Euro USD hasn't seen high volatility as of yet, which is very interesting if we take into account that we've seen an election last weekend, which can surely be interpreted as European skeptical. Sure, there was several media pointing to a potential better result, and we haven't seen this strong results for the right-wing parties at this election. Potential reason probably the developments in Austria the week before, but still, I have to say, personally, I think it was a very, very good result, very strong result for the right wing and Eurosceptics. And I think it perfectly illustrates also why we have seen no further gains, but today see, in fact, or only today see a push higher, but have seen losses and a potential retest of the region around 111.10 here, the current yearly lows in the last days or over the last days. So it was not only that the Brexit party in the UK saw very strong results under Nigel Farage, but also, for example, the Italian Lega, and here the Mr. Salvini saw a very strong result. Same is true for Italy, for example. In Germany, the right-wing alternative for Germany, so AfD, it's called Alternative für Deutschland, they weren't as strong as expected, to be honest, but still, I really want to focus here on Italy and the result in Italy. And Italy was, in fact, very strong in regards to this election, and the coalition between the Lega and the Cinque Stelle Movimenti, this is five-star movement, is now switching, and the Lega obviously has is getting some backwinds here, which can already be seen in several attacks being taken from Salvini on Brussels again in regards to the budget. And I think what we can clearly spot is clear tensions forming here and having the potential of pushing the euro lower in the days to come. This is especially true next week here. We're looking at the ECB, and I have to say I see a wait and see approach, or potentially a quite dovish stance in the rhetoric. And this is mainly given by the fact that on Wednesday already, so 2 days ago, there were numbers from Germany coming around the employment change. And what you can clearly spot here is there was a surprise, obviously, on the upside. So Germany's seasonally adjusted number of unemployed increased by 60,000 from a month earlier, following a 12,000 decline the previous month and well above market expectations of an 8,000 fall. So we expected a further drop here, which didn't happen. So that means nothing more. That was a very weak data set. And what's very interesting is it was the first rise in registered unemployment since 2017, June, and the largest in a decade. Or to put it differently, obviously, there's also potential signs of a recession forming at the horizon here in Germany, the biggest economy in Europe. And with this in mind, it would come as a big surprise if journalists will not take the chance to especially ask Mario Draghi what he thinks about that, and if there is any potential moves from the ECB, which is especially true when looking at the latest developments around the trade war. Trump is stepping back a little from attacking especially the automobile sector in Europe here, especially trying to hit Germany. But this is not because he thinks it does make sense, or I'm good friends with Germany, respectively Angela Merkel, the German chancellor, but it's more like he does not want to have another potential trade war with the Eurozone here when we're facing these strong headwinds from China right now. And so the question will be if there's any attempt to down talk the euro, which is just natural and logical based on the fact that you try to counter tariffs by just devaluing your currency. to just reduce potential negative effects. There's still negative effects on trade in general, yes, but still you try to counter those tariffs, so those measures then by devaluing currency. And the central bank, in this case the ECB, has the tools to do so. It will be of high interest how the ECB attacks these developments, especially after now more and more economic data from Europe, respectively Germany, coming in, which point to a very, very weak economic development in the months to come, in fact. So, and with this in mind, you can already see that my outlook for the euro stays bearish, and I'm quite sure, to be honest, that rather sooner than later there will be a push below 111, even though I have to say I don't really want to anticipate such a break, but trade such a break directly, because so far the US dollar has had some trouble to really gain momentum against the euro, and this is especially true after the 10-year US Treasury yields pushed to new yearly lows, in fact. And still I'm bearish, and once we break below 111, I think further losses are very likely to happen down to 109, 0950, probably as low as 08, 0770, 08. And this bearish outlook is true as long as we trade below 113.30. So this is the level we have to reconquer to negate this negative outlook for the euro. But I think the bears are still seeing an advantage on their side at the current moment. And yeah, we also want to surely have a look here at dollar JPY. And why do we want to have a look at this currency pair? Because we are now targeting a very important region. And in this context, I've also had something, I haven't prepared it yet, but I want to show you how to get there. admiralmarkets.com, the website, and then you go to analytics, and there you go to technical analysis. And if you click on this, you can see here today's dollar JPY article, and you can already see it here, all eyes on the crucial support around 108.70. I've prepared this article, by the way, already yesterday, so that was before Trump made his tweet, so you won't find any news on this tweet within this article, but the tweet is yeah, leaving me waking up on the right side of variance, let's say. So I to some extent, I'm very happy, because now this region becomes an important aspect into the weekly close. And there you can also see 108.70, where further targets can be found. Then first target is 107.50, and then in the days to come, probably here the flash crash lows from January, 104.70, 105. And yeah, so in fact, next week, this is also very interesting. It's not only trade war fears and potential risk off and an unwinding of carry trades here, resulting in JPY strength, but there's also several other very important economic data which will be published. So any disappointment here, any ISM manufacturing, any ISM non-manufacturing, any IDP, especially any NFP reading, which comes in below expectation, can naturally then result in further losses here and giving the final push to a further escalation from a trade war perspective and risk off mode hitting the markets, which usually favors gains in the JPY. And if we make it below 108.70, a level which we are currently eyeing, then we are surely seeing the advantage clearly being found on the downside. And this is true as long as we trade below 110.70 here on the downside. Some might probably round this up and say 111, but I think the overall outlook is bearish. There's a clear bearish touch, and it's clearly bearish once we break below 108.70. And yeah, when we talk about dollar JPY and a usually very yield sensitive currency pair, we also have to have a look surely here at gold, which is also now gaining momentum again. Risk off is hitting, and this is especially, as I mean, at the beginning of the week, you probably have seen some lines in the technical analysis section on gold from our end, where we stated that the head shoulder formation is still in play as long as we trade below 1,310 USD. Some might probably also say as long as we trade below 1,325, but I think 310 is already a level to watch here. And if we make it back above that, this head shoulder formation is off the table. And now we already and also noted that any trade war escalation, any potential risk of hitting the markets, any attempt to down talk the US dollar from the White House, whatever, is capable of resulting in another push higher, which meant nothing more than be really careful with anticipating a break below 1,266 and gold pushing lower, because so far there are too many components which could negate this picture. And so you should probably wait for a clear break to happen, and it didn't. In fact, the trade war escalated to a new level overnight, with Mexico now being on the list from Donald Trump and among the next country which is attacked here. And that means nothing more than we are now about to see probably weekly close above 1,300 USD. Would consider, let's say it that way. I would consider such a close very strong, and especially if we make it above 1,310, I could really see, or I have to say, I definitely see quick gains up to 1,325, and probably also a sharp push up to 1,347. And this is especially true also with the developments around yields in the US. Dropping yields are usually bullish for gold in this case. And also, if you expect gold, usually you not necessarily expect gold to gain in an environment where the US dollar gains, but I think risk aversion here could really overcome this natural correlation, negative correlation in this case, which means nothing more than if really risk off hits, I think gold has definitely a clear chance of spiking, probably squeezing higher to new yearly highs, even if the US dollar gains. So this correlation is not necessarily given then anymore. And yeah, let's just see how things develop. I definitely look forward to the upcoming week and next Friday. It will be a day when the NFPs will be published. It will be around 1:30 before NFPs are published, while we already have some economic data, which probably acts as kind of indication. We are in a great spot to know what the ECB delivered. We probably see further developments around the trade war and escalation, what this brings us for the equity market. So I really look forward to next Friday. And if you liked this webinar, feel free to register for it for next week. If you're watching the recording, please share us, like us, respectively register for the webinar next week. And so that's it from my end. Have a nice weekend, enjoy yourself, and talk to you next week. I definitely look forward to it. See you, and bye-bye.